So again, the Federal Reserve coming out in a new statement, not changing interest rates, but a couple of things standing out here. The FOMC saying that risks to achieving its employment and inflation goals are moving into better balance. At the same time, the committee saying it's not going to be appropriate to reduce its target range until it has gained greater confidence that inflation is moving sustainably toward 2%. Is this what the market wanted? Is this what it expected? Let's talk more about that. For that, we bring in John Stoltzfus, Managing Director and Chief Investment Strategist at Oppenheimer Asset Management, and Blerina Uruçi, T. Rowe Price, Chief U.S. Economist. Thank you both for joining us. John, let's start with you here. As you said in a recent note, the Fed funds futures market has some rose-colored glasses on in its expectation that the Fed could still maybe cut in March. Does this change that expectation at all? Will it sort of reset them?
Well, thanks for having me on the show, Julie. I've got to say, when we look at this, we're not surprised at what the way the Fed is coming out of the FOMC meeting. We think the market was earlier expecting something like 5 to 6 cuts in interest rates starting as early as March. We think this is likely into the second half of the year. If it's earlier, it'll be at the midpoint of the year because the economy remains resilient.
And Blerina, I want to get you in here as well, get your take, one, on the statement and also what you're expecting to hear from Jay Powell at the presser.
I thought the statement came in line with consensus expectations in the sense that they removed from the statement language that kept the optionality of further tightening in monetary policy. So we know broadly that the Fed is done with a tightening cycle and the next move will be a cut. There was something unusual in the statement. It was very clear and uncaveated in terms of when the next cut will be, and they basically clarified that it will be when they get greater confidence that inflation is on a sustained path to 2%. Now, from the press conference, I would expect Powell to give us a little bit more detail on what would make them feel more comfortable with a path in inflation, because the data we've received so far suggests that 3-month annualized core PCE is 1.5%, and it's been running around 2 or below for the last 6 months. And we received today a downside surprise in the ECI measure of wage inflation, which is the Fed's preferred measure. So we are seeing progress on inflation and wage pressure. So just need to get a better sense from Powell what it is exactly more that they need before they're comfortable that real rates may be too high and they need to come down.
Blerina, it's funny you said we're going to want to know from Jay Powell in the presser what he's looking at, because I was going to ask you, what do you think that they're going to say in terms of what they need to see to really be convinced about the sustainability of that sub 2% path?
So just to clarify and divide this into 2 parts. First of all, I think for the press conference and the statement, the best possible outcome for the Fed is that they don't leave the market with a great sense of certainty that a cut is coming in March, simply because we have 2 more inflation reports before that meeting and 2 more labor market reports. And we know from last year that we got those upside surprises and revisions to both inflation and employment data. We don't want to repeat the mistakes of the past. We don't want to give markets a false sense of certainty here because the Fed is truly data dependent. But we also know that when interest rates increase very fast, something breaks in the banking system. And so the Fed will want to hedge itself against that as well. So I think they want maximum optionality. And so as neutral as possible during the press conference would be an ideal outcome for Jay Powell. As it comes to what will happen in the end, I do think that we have enough progress in train on the inflation front, and we'll see enough deceleration in the employment data that will probably get a cut at the March meeting. But there is nothing to be gained for the FOMC and Jay Powell to signal that very strongly right now.
And so, John, to bring you back in here, as Blerina said, the Fed data dependent between now and March. We got employment reports, we got inflation reports, plenty of data still for the Fed to kind of make sense of here. And we're all trying to place our bets, John, on what the trajectory of rate cuts looks like. I'm wondering what you think, John. Is it when you think the cuts come, first half, second half, and does it matter to you, John, as an investor, as a market strategist, on the timing of that?
Well, when it comes to this, the timing of this, we look at it. We think the Fed has been very clear. Jerome Powell and his Fed do not want to be remembered like Arthur Burns is remembered as failing to act against inflation and letting inflation run for about 7 or 8 years before Paul Volcker had to take draconian measures to take it back. They want to be more in the Ben Bernanke legacy, and as a result of that, they have been extremely, we think, sensitive. I've been in this business since '83, so I came in the second term of Paul Volcker. So I remember when rates were a lot higher than they are today and inflation was running a lot hotter. They don't want to go back to there, and I think the market never trusts the Fed. And especially when you look at the trading floors and the trading rooms, what they trade on is very different than what intermediate to long-term money managers like myself are going to be looking at. What we look at is we don't think the Fed thus far has not pushed the economy into a recession, even as it has raised rates for almost 2 years. It was only aggressive when it raised 4 times, 75 bips at a time. So and then it's been on long pauses, with the exception, I think, of 150 or 125 bips hike somewhere along the way in there. But the point is, this Fed wants to have its cake and eat it too. And so far, almost 2 years into the Fed funds hike cycle, it has. And I think when Jerome Powell speaks today with the press, the message will probably remain the same, essentially. There may be a few tweaks in words, but it does remain data dependent. And that's a good thing, we believe, for the market. We're in an environment where bond buyers now get something in return in the form of a coupon, and bond issuers have to pay for the privilege of borrowing money. Great for intermediate to longer term investors. For short term investors, especially those who depend on extreme margin or leverage, it's a tough environment, and they'll protest very hard.
And John, expand on what this means for the equity market as well. Particularly, I'm looking here at a day when we're seeing the NASDAQ, which has been leading stocks, of course, higher because of the Magnificent Seven, is falling, because 2 of the 7 and 1 of the, 7 plus, AMD, I guess you could call it, is dragging things down. So what does that imply about the importance of the Fed or not importance of the Fed as we go forward?
I think, it's in this case, it's tech has had a phenomenal run. A lot of things were priced in. The responses here in technology results have been somewhat harsh on disappointment and rather unrewarding on positive surprises overall. And yet the results are not so bad. And we can't on a quarter-to-quarter basis, you're bound to have some disappointments. It's quite natural. It's part of the nature of business. But for traders, the bet is always on quarter-to-quarter performance, or even shorter than that as a rule. And so it creates volatility. We think for intermediate to long-term investors, an opportunity on pullbacks to look for the babies that get thrown out with the bathwater, the good stocks that are suddenly priced more attractively because they get sold off in any kind of a haircut. It doesn't have to be a correction, but just in haircuts, sometimes specific stocks get hit particularly too hard. And for traders, it's an opportunity to trade. They can play the game.
Blerina, I want to get you out of here on this, just as our resident economist on the panel here. Blerina, I just get your take on some of the headlines we got today. Blerina, you saw the ADP print that came in light. These headlines, Blerina, we saw on New York Community Bank Corp. Those causing you any kind of concerns about your outlook for the U.S. economy for 2024, or are you still sticking with the kind of soft landing scenario here?
I do think we have a deceleration in the labor market. Slack is being created pretty fast, first through fewer vacancies, but we're also seeing the pace of job creation slow down significantly, the base of job creation narrow, and we're seeing some headlines of layoffs as well. So I think the Fed will start to become much more attentive to the full employment side of its mandate now that inflation is coming closer to target. So I do expect deceleration. That ADP number, I think that's been underperforming the payroll data for some time. There is a divergence between the two surveys, and probably reality is somewhere in between. But I'm not seeing yet the base of layoffs being so widely spread that it gives me concerns about a recession at this point. And a Fed that is attentive to its full employment mandate and is preemptive in its rate cuts as inflation comes down, I think that just adds to the odds of the economy doing well this year.
All right, Blerina, John, thank you both so much for helping us kick off the big show today. We appreciate it.
All right, thank you.